Today, we are talking about what you should be doing before year end if you are planning for retirement or you are already retired. All that and more on today's episode of The Retire Once Show. Hello and welcome to The Retire Once Show, the show designed to help you get to retirement, but most importantly, stay retired. I'm your host, Johnathan Rankin. I am the founder and CEO of Theorem Wealth Management. And as always, I am joined by my lovely co-host.
Hi, I'm Melissa Rankin. Thank you so much for joining us.
Boy, do we have a great show for you today. Can we all just celebrate? The midterm elections are finally over, so
all those text messages that we get to, remember to vote can finally be done.
I'm so tired of getting those from a state that I do not even live in anymore. So please stop sending those text messages because let's just face it. If you're making your voting decisions based off of a text message that you get
to remind you to go vote
the day of the election, you're probably not going to get that vote there. So today we are going to be talking all about what you should be doing between now and the end of the year.
Which is basically next week, let's face it.
It does feel like this year has already flown by. And I mean, everybody's getting their holiday shopping already, at this point, right?
I mean, we're not, but
no, we're definitely not.
A lot of people, yeah. I mean, based off the amount of Christmas decorations I've seen up, around, and in stores, yeah.
Yeah, but that all happened, Labor Day? I'm pretty sure I saw Christmas trees, right after Labor Day.
I'm pretty sure they were there at least before Halloween, for sure.
That is true. So aside from any sort of holiday shopping, if you're planning for retirement or you are already retired, there's a lot of different things that you should be doing. And it's not just breaking it down into retirement strategies. There's so much more. There's obviously things on the planning front that you want to look at, investment side of things, some tax things to avoid some Uncle Sam payments. And then
you always want to avoid that.
Absolutely. Who wants to pay more to Uncle Sam?
Not me.
So let's dive into that today. We're going to cover a lot today. So thanks for being here. Before we hop into any of that.
I was going to say, you skipped a few parts.
I didn't skip a few parts. I didn't know.
You forgot to ask people to follow us and subscribe so they never miss one of these amazing episodes.
You know what? You're right. I almost forgot about that. So while we're bickering about that, you could just click that subscribe button that's right next to the screen. YouTube actually changed it from red to black, so you can click that one now. I was going to say the red button, but just find it wherever you're listening to this. Click that, support the show, and we appreciate that.
But now that we've got all the housekeeping stuff out of the way, I think that we should just get to it.
That's right.
So with that, let's start with the retirement side. What do people need to do before the end of the year?
All right. So the first thing that you want to do, just take a breath and just assess where you're at. Just figure out, okay, given what's going on in the market today, this is the time where you just, if you think about, everybody puts together their, New Year's resolution, and a lot of them involved, hey, I want to lose 20 pounds or something like that. The first thing you got to do is you got to step on the scale. This is your opportunity to be between now and the end of the year. Step on that retirement scale and just assess where you're at. Are you still on track? Has the market impacted your goals? Now that inflation's only, it's down. It's only 7.7%. Only, and everybody, the market's rallying as this news came out. And I guess they think it's back to, where it should be in the twos. So we've got a long way to go.
Yep. A little bit of an uphill battle.
It seems like it. So you want to assess now, are your goals still feasible? A lot has changed since the last time that a lot of people looked at their retirement. And if you haven't gone through your updated retirement plan in a long time, the market's changed. Your values are different. You want to see where you stand today. So the first part is just assessing it. Just take a look at where you are today. Second step, now this is where you actually start implementing the diet and workout plan.
Where you actually have to do some work.
You got to go to the gym at some point if you're starting that New Year's resolution. That's why.
Or at least put down the cookies.
It is the worst day to go.
You don't have to jump right into the gym. I mean, let's face it.
Well, January 2nd, worst day of the year to go to the gym. That's where everybody goes. Well, now you can do this exercise while you're sitting in the comfort of your own home. Update your retirement plan if needed. So after you assessed where you're at, if you feel like, maybe I'm not on track. Maybe I don't know if I'm on track. The market is down. Maybe that really has impacted my portfolio or my goals more than I think it should. Now's the time where you want to update your financial plan and just see, one, if you're not retired, do you need to delay retirement if you're planning on it in the next couple of years? If you are retired, do you need to adjust your retirement spending? We talked a little bit about this last week when we talked about that 4% rule. And with everything changing, living off of one just steady income for most people just isn't practical. And so now you want to see, is your long-term longevity of your portfolio okay based on what's going on in the market?
I think that's important to take a note of. We did go a little bit further into that last week, but you always want to know where you're at, but especially right now.
Yeah. And then the last thing you want to do while you're updating that plan, if you have the ability and you're still planning for retirement, you're years away, think about increasing your savings. This might sound counterintuitive, but hey, everything you're buying now is cheaper than it was last year for the most part. So use this time. If you've got a runway till you retire, this might be one of the best times that you can start putting money to work because the market is down. So once again, just assess where you're at. Put yourself on the scale, the retirement scale. And then from there, step into the retirement gym. Look at that. We can start a whole new thing.
This is a whole analogy here. We've got a whole thing going.
I got you guys. Don't worry about it. I've got you.
Okay, so that's on the retirement side. Let's talk about the investment aspect of things. What do people need to do for year end to be prepared on that side?
So the first thing that you really want to do from an investment perspective is just see, how do you feel about what's happening in your portfolio? You know, we talked about this before in previous episodes, but is your risk tolerance, are you taking on more risk than you should? You know, looking at that risk tolerance and saying, you know what, this year was a lot rougher than I anticipated.
I think everybody felt that way.
I agree, but you want to put that in perspective of what is your asset allocation? What are benchmark asset allocations doing? Are you in line with that? And are you still, no matter what, are you comfortable with the losses that you've taken? Because now is the time where you can update that, that risk tolerance. Check your time horizon. What is your time horizon? Going back to that plan, are you a long-term investor that has time to watch things play out? We know, and I said it, I don't know how many times have I said it on this show, the market's going to hit an all-time high at some point.
He's said that, I think, just about every episode.
Oh, when's it going to hit that all-time high?
We don't know.
We don't know, but it's going to happen at some point. Don't
you
know
heard
when.
It here first.
You heard it here first.
A few times. Breaking
news at the 10 o'clock news. We have an all-time high on the stock market. When?
Someday.
So just knowing that at some point the market's going to get back to an all-time high, you just still want to assess if your risk tolerance and your time horizon, are those still where they need to be to base your portfolio asset allocation. And then that third thing you want to look at is, what is your target asset allocation? What should it be? And we're no longer in this secular bull market that we saw for 13 years. We are now in bear market territory, and we're going to be in a different environment, in my opinion, for a little while. And so you want to make sure that your target asset allocation, so how much do you have in stocks, bonds, cash, other investments, what does that mix need to be to give you the right risk-adjusted rate of return moving forward? Now, the second thing you want to do, so once you figure all that out, you know what your risk tolerance should be, you know how long you've got from a time horizon perspective, and you've figured out your target asset allocation. Use this time to rebalance, because the markets change, your asset allocation might be completely different than where it should be. And by rebalancing, this is going to bring you back into that target risk, that parameter that you want to be at.
Because chances are, unless this is an exercise you're doing frequently, that probably is going to need some adjusting.
Yeah, and what I've seen when talking to a lot of people this year, this is the year of the ostrich. I know, being half Chinese, I know that's not a year in the calendar, but it is when it comes to the investment front during a bear market, where the head in the sand mentality has been very predominant this year. And that's okay. A lot of people, they don't want to look at it when the market's going down.
I wonder what your Chinese dad would say about that. You calling it the wrong thing.
Well, no, I even said that it's not on the Chinese zodiac.
I know, but then you probably should have said what was this.
I'm not going to get into all of that. This is a retirement show, and my father will correct me about that later. So,
moving on.
Just make sure that this is a time where you're rebalancing. You're just looking at everything. The third thing you could do on the investment side is use this time to do some tax loss harvesting. And so, tax loss harvesting, this is where, if you have any losses in your taxable portfolio, so not your IRAs or 401ks, because cost basis doesn't matter there, but if you've got a brokerage account that you've been investing in and you've got gains in certain positions that you've held for years and you didn't want to sell them because you were locking in that capital gain and you have to pay Uncle Sam, Well, if you have any losses in your portfolio, you can use those to offset those gains. So this is a perfect time to go back to rebalancing your portfolio and reallocating things. Maybe you have some gains in some of those high-tech growth stocks that did well for, the past decade, and now you want to reallocate into something different. Maybe you have some losses in some side of your portfolio that you just want to be able to offset those. One thing to be aware of, though, is the wash sale rule. You can't just sell things today to lock in the loss and then buy the same things tomorrow.
Unfortunately.
No, that's not the way it works. You do have to wait 30 days to buy the same security, but you can buy things that are either similar to it or in the same sector. If you have questions about that, we'll be happy to walk you through that process, but making sure that you're not buying the same security because that just throws the whole thing off.
So you want to rebalance, but do it correctly.
Exactly.
Okay. I feel like there's so much around tax strategies. There's got to be more than just those things, right?
There is. So the big one that a lot of people talk about, especially when the market is down, is using this time to do a Roth conversion.
We hear that a lot.
And this is where you're taking money from your traditional accounts, putting it into a Roth that has no RMDs. It doesn't become taxable anytime you make withdrawals from it. But just remember, if you do that, you do have to pay the taxes this year. So that is one thing you got to figure out. Do I want to pay the taxes this year? And the second thing is you got to make sure that you're considering what your future tax bracket is going to be. I get this question all the time. Traditional account versus Roth. Which one's better? Which one should I invest in? And we've covered that a few times here. All that matters is what tax bracket are you in today and where do you anticipate being in retirement? Because if you're already in a high tax bracket today, it doesn't make sense to move the money into a Roth because you're just paying taxes at a higher amount.
Again, it's about your personal situation.
It is. And this one gets very personal because there is no one size fits all. There are times where you might want to do this over stages over the course of a few years. If, let's say that you left your job in the middle of the year and this is a year where your earnings are going to be down, it is a very personal thing to each individual person. So if you have questions about that, there is a link in the description below. You could schedule some time with us. We'd be happy to help you out with that. But aside from Roth conversions, use this time to maximize medical and charitable donations.
It is the time of giving.
It is the time of giving. However, one thing you might want to consider is maybe bundling your donations every 2 or every 3 years into a larger amount. This is common where I've seen people that give a steady amount every single year to certain organizations, and that's great, but that doesn't really maximize the overall deduction that you get. Whereas if you bundle those, you can get a much larger charitable deduction. The other thing on the medical front, maximizing the medical deduction as well. Because you can only deduct everything that is over 7.5% of your income. If you've had procedures this year or you've had high medical costs this year, what things can you pull forward that you might be doing next year into this year, whether it's exams or tests that might need to be done, procedures,
checkups, anything
that you can do by the year end that can be deductible if you're over that 7.5% limit. And so those are things that you definitely want to consider over the next, we got almost 2 months.
Does not feel like it.
Does not feel like that because obviously everybody's going to be closed the week of Thanksgiving or
the week of Christmas.
So there is a lot going on, but you still do have time. It's not like we're talking about this on December 16th, which is a great day, a fantastic day. That is
the day I get a year older.
That is the day she gets a year older. She turns 30 again. So,
yay!
Last thing on the tax strategies, do not forget your required minimum distributions. So if you are over the age of 72, make sure you do not miss that. You've got a long time. We're giving a very long warning for this because if you miss an RMD even by 1 day, it's a 50% penalty.
It's very important.
That is a lot more to Uncle Sam that should go into your pocket because 50% is a very stiff penalty for missing it by a day.
Yes, you don't want to do that just because you overlooked it.
No. And then you also want to consider year-end gifting. If you do give annual gifts, whether that's to a 529 account or you just decide that you're very generous. And you
Which would contradict our earlier point about maybe saving, but
It does. But if you do want to gift money, make sure that you do that by the end of the year. This year, the annual exclusion is $16,000 for an individual and $32,000 for a married couple. So make sure you get that in by the end of the year. And lastly, on the tax strategies, maximize your 401k or just any retirement plan contributions. And just a reminder, for 2022, into accounts like a 401k, the maximum you can contribute is $20,500. And then if you're over the age of 50, you can catch up and do an additional $6,500. So you can save a total of $26,000 in your 401k. So see where you're at today, how much you've contributed, and do you need to increase your contributions for the rest of the year to try to get up to that max if you can. And then if you don't have a 401k, you're just saving in a traditional or a Roth IRA, the maximum that you can contribute there is $6,000, and then you could do the additional $1,000 if you are over the age of 50.
Which we highly recommend if you're able.
Absolutely. If you can max that out,
take advantage of all of that.
Do what you can.
Okay. You mentioned a little bit about maximizing benefits and things like that. I know that you were talking about giving and whatnot, but how can you do it a little bit more geared specifically toward your health situation?
Well, one account that we've talked about as being the most underutilized account for retirement planning is the HSA, or the health savings account. And so if you're on a high deductible health plan,
he feels very passionately about the HSA.
This is a fantastic account. And I think that it is very underutilized because high deductible plans, if you need health care right now, yeah, they're not ideal. But if you have the ability to be on a high deductible plan, use this time to take advantage of that HSA and make sure you get that contribution in by the end of the year. And just a reminder, that is the only account that is triple tax-free. Tax-free going in, tax-free growth, and tax-free when you use it for qualified medical expenses. So because of that, we don't give any money to Uncle Sam on this one.
So it's all tax-free. I think that's why he really, really likes it.
Love this account. I mean, Uncle Sam, I guess we love you too, but, not like that.
We don't want to give you money if we don't have to.
The other account that you want to make sure that you're maximizing by the end of the year, and this one's important, is the FSA. If you have a flexible spending account, because unlike an HSA, these funds don't roll over and you're going to lose them if you don't use it.
So again, if you have anything that you're thinking, I'll take care of that in January or next year, medical-wise, do it now. Don't lose any money that you've already paid.
And this is a time where every single optometrist is telling you, come on in, get your eyes checked, because they want to sell you a pair of new sunglasses that you're going to use that FSA for.
I've already gotten that, actually.
Yeah, every year. That's what they do. And just make sure that you're not letting any of those funds go to waste. And the last one, this might be a little bit more specific for certain companies, but it is very popular nowadays for large corporations to offer a legal benefit. And making sure that...
Which is huge. I mean, you should definitely look into it if your company offers it, because it's a really good thing.
It is, and it's usually only anywhere between, I think, $10 or $20 a month. But most people, they do this, they sign up for it, and they don't use it for a very long period of time. They just,
if at all.
If at all. But make sure that if you signed up for it last year, or if you're going through open enrollment right now and you're considering signing up for it, one of the benefits is that you can use this to put together your estate plan. It's not the most complex estate plan, but it's really a good plan for what most people need. You're going to be able to get your trust put together, wills, your powers of attorney, all those things that most people need, the outside of very complex strategies, you're going to be able to get utilizing that legal benefit. So if you have it, just make sure you use it.
Which is the theme around a lot of these items. If you have it, use it.
That's right.
Okay, so we've covered a lot of information here, but I feel like there's probably a few other key points that we really think people should focus on for the end of the year.
That's right. One of them is your emergency fund. It's been a really challenging year in the markets, just with inflation, costs going up. So a lot of people might have tapped into their emergency fund. If you have, make sure that you're just seeing, where is that at today? Do you need to try to build that back up? And, with corporations, we're already seeing it with large tech companies where they're starting to lay off employees. You want to make sure that that is at that 3 to 6 month range, if not even more. So just assess where that's at. Review your insurance needs. Now, this isn't just for life insurance or medical insurance. Use this time to look at your homeowner's insurance, auto insurance. They just increase rates sometimes, and it's on auto renew. I know ours
and you don't
are.
even notice it.
I looked at this just the other day because ours were coming up for auto renewal, and I just looked at it quickly and I thought, that's more than it should be. And so you start digging into it and realize, okay, do I need to shop this around? Review or update your beneficiaries.
That's always a good one.
It is. This is on 401ks, IRAs, any retirement account. You want to make sure that if you've had any life changes, or if, let's say, you established an account and you never put a beneficiary on there, you just want to make sure that those are updated and listed and that they're correct. And so use this. This is a good practice to do once a year. So in 52 weeks, we will see you back here going over the same thing.
It'll sound a little bit different, but that one's probably going to stay the same.
That's true. And then lastly, review your tax withholding. I know a lot of people like to get that tax refund come the beginning of the year, but all that means is that you gave our friend Uncle Sam a interest-free loan. So you don't want to do that. Make sure that your tax withholding is getting you to the point where you're breaking even, if possible. So just review that before the end of the year. So those are all the things that you should do. I know it's
lots of information,
long checklist. Add all of that to decorating, figuring out how to not cook a dry turkey, make sure that you have plenty of desserts for Thanksgiving because that's all that matters, and spending time with family, friends, loved ones, you name it. So that's a long list.
And make sure you stay in that holiday spirit.
That's right. So with that, I'm Johnathan Rankin.
And I'm Melissa Rankin. Thank you so much for joining us.